Hey, welcome back to Smart Stock Sam, the channel where we cut through the noise and let the data do the talking. If you are new here, hit that subscribe button right now because every single week we bring you deep dive breakdowns just like this one. And today we are going deep, very deep, on a stock that has completely taken over the conversation in small cap trading circles. We are talking about Datavault AI, ticker symbol DVLT. Before you put a single dollar into this name, you need to watch what we are about to break down. We are going to cover the jaw-dropping revenue numbers, a $2 billion financing deal with a dark side, suspicious insider activity, an army of short sellers hiding in the shadows, and a very specific data-driven trade setup for the week of June 8th through the 12th of 2026. The full picture is wild, it is complicated, and it absolutely demands your attention. So grab your notepad. Let's get into it. Let's start with the fundamental contradiction at the heart of this story, because it is genuinely one of the most bizarre setups. On one hand, Datavault AI just posted 443% year-over-year revenue growth for the first quarter of 2026. Say that number out loud, 443%. They are targeting $200 million in full-year revenue. In any other environment, a small-cap company posting those kinds of numbers would be going absolutely parabolic. It would be the kind of move that turns a small account into something life-changing. But here is the other hand. On June 5th, the stock closed at just 42 cents and 94 hundredths of a cent, a 42.94-cent close, after suffering an 8.01% drop in a single session. The market looked at 443% revenue growth and said, "We are selling." That tells you everything. The market is not trading the revenue. The market is trading the risk. And the risk profile on this stock right now is something you need to fully understand before you touch it. So let's map out exactly how we got here, because this collapse did not happen overnight. On June 1st, the stock was sitting up near 58 cents. Then came the announcement of a $2 billion term sheet with a firm called Helmex Capital, and instead of ripping higher on that headline, the stock started dropping. The very next day, June 2nd, the company tried to stabilize things by announcing an agreement to list tokenized commodity assets, specifically MTB Copper and Gold Vault, on the Perpetuals.com exchange. It barely moved the needle. Then came June 4th, which brought a brutal $25 million deadline we are going to talk about in detail in just a moment. And then June 5th delivered the killing blow. The U.S. May jobs report came in hotter than expected, adding 172,000 jobs, which completely crushed any near-term hope of Federal Reserve interest rate cuts and triggered a broad sell-off across the entire tech sector. So you had company-specific fear smashing into macroeconomic headwinds at the exact same time. That is a perfect storm, and the chart shows every bit of that carnage. Now let's talk about that $2 billion Helmex deal, because this is really the centerpiece of the entire bull versus bear debate. And I want to be completely fair here. There are genuinely bullish elements to this agreement. The deal is structured across 4 distinct $500 million tranches, and it includes a global tokenization exclusivity mandate that represents significant operational scale. If you are thinking about where the world is headed with blockchain, tokenized real-world assets, and decentralized finance infrastructure, having that kind of exclusive mandate is not nothing. The bulls are right about that. But the bears are drowning out the bulls right now, and they have very legitimate reasons. If this deal closes in its current form, it is massively dilutive to existing shareholders, and it gets worse than just dilution. The Helmex counterparty would gain enough voting power to elect a majority of the board. Think about what that means. You are not just having your ownership stake reduced. You are watching the entire leadership and strategic direction of the company potentially get handed over to a new controlling party. Current management would effectively be handing over the keys to the kingdom. And on top of all of that, this is still a non-binding term sheet. It is subject to extensive regulatory approvals, due diligence, and legal processes. the bullish headline and the bearish fine print are living in complete contradiction with each other. And now we get to the detail that is really giving institutional money managers absolute heartburn: the $25 million non-refundable fee. Here is how this works and why it matters so much. In order to keep that non-binding Helmex term sheet alive, meaning to preserve even the option of closing this deal, Datavault AI was contractually required to make a $25 million non-refundable payment by June 4, 2026. Read that again. Non-refundable. They had to fund this massive capital outlay by liquidating their Bitcoin holdings and selling company receivables. They are paying a hard, permanent, unrecoverable fee to keep the rights to a deal that the counterparty can still legally walk away from. If the $2 billion Helmex financing ultimately fails to close, that $25 million is gone forever. It becomes a permanent capital loss on the balance sheet. Management is not hedging here. They are betting everything on this deal crossing the finish line. That is either an act of supreme confidence or the most expensive gamble in the company's history. But here is what makes this situation genuinely complicated, and not just a simple short story. If we set aside the financing drama entirely and just look at what Datavault AI is actually building, the underlying business is extraordinarily compelling. We are talking about DelivMeds AI, a proposed $4 billion healthcare technology and logistics platform built on their pharmacy chain blockchain intellectual property. With a binding term sheet already in place with Wellgistics Health, that is real contracted pipeline. On the compute side, they are deploying a 48,000 GPU edge network. Do you have any idea how valuable that level of computing infrastructure is right now, in the middle of the current artificial intelligence gold rush? That kind of distributed GPU capacity is extraordinarily rare and astronomically valuable. And they already have over $800 million in locked, signed tokenization contracts sitting on the books. This is not vaporware. This is not a white paper. This is a company with real, contracted revenue. It is precisely why Maxim Group maintains a buy rating on the stock, with their long-term thesis anchored entirely to this infrastructure build-out. The foundation is genuinely strong. The question is whether the financing structure destroys it before the business can fully realize its potential. Now let's talk about the piece of data that should make every retail investor stop and think very carefully. Let's look at the flow of institutional versus insider money, because these two groups are telling completely opposite stories. On the institutional side, believe it or not, you actually see evidence of long-term support building. There are 102 institutional owners holding over 46.39 million shares, representing 5.42% of the float. And that institutional ownership increased by 26.13% in the most recent quarter. Vanguard Group is among the institutional buyers. Sophisticated, long-horizon capital is quietly accumulating. That is a meaningful data point. But now look at the insider activity over the same period, and this is where the alarm bells go from a quiet hum to an absolute siren. Over the past 6 months, there have been 19 insider sales and zero insider purchases. Not one person with direct knowledge of this company's internal operations and financials has bought a single share on the open market. The most devastating transaction came from Vivasor Inc., a 10% owner, who dumped 20 million shares between May 4th and May 7th, cashing out over $11 million and slashing their ownership stake from a major holder down to 6.5%. And it was not just Vivasor. The Chief Executive Officer, Nathaniel Bradley, and the Chief Financial Officer, Brett Moyer, the two people who know more about the financial health and strategic direction of this company than anyone alive, both hit the sell button. When insiders sell, the narrative they give you is always the same: diversification, estate planning, personal financial needs. But when the CEO and CFO are selling shares in close proximity to a massive high-stakes financing announcement, you have to sit with one very uncomfortable question. What do they know that we do not? Wall Street has absolutely noticed this insider flight, and the short sellers are circling. Right now, there are 88.89 million shares sold short, making up a massive 15.01% of the total float. The days to cover ratio sits at 2.27. This is not casual short interest. This is aggressive, coordinated institutional pressure. The hedge funds see the dilution risk. They see the non-refundable fee. They see the insiders exiting, and they are hammering this stock relentlessly, trying to push it into the floor before any positive catalysts can develop. But here is where the short thesis gets really interesting and potentially very dangerous for the bears themselves. If we dig into the intraday mechanics from June 5th, the hidden data is staggering. Off-exchange short volume, the kind that flows through dark pools and is completely invisible to everyday retail investors, hit 69.61% on that single day. Nearly 70 cents of every dollar of shorting activity is happening out of public view. It is hidden institutional warfare being waged against this stock. But this aggression is costing them dearly. The annualized borrow fee to short Datavault AI stock has exploded to between 11.42 and 12.92%. That means short sellers are paying nearly 13% annually just to maintain their positions. When borrow fees get this high, it tells you one critical thing. There is enormous demand to short the stock, but the available supply of shares to borrow is extremely limited. And that mechanical tension, high demand, low supply, expensive borrow, is precisely the fuel that ignites a short squeeze. The coil is tightening. Now, let's look at what the technical charts are saying on top of all of this. The daily moving averages are currently rating Datavault AI as a strong sell. The stock is trading well below its 50-day moving average of 49.5 cents and its 200-day moving average of 54 cents. The immediate dynamic support sits at the 5-day moving average around 42.2 cents. The MACD is in negative territory at negative 0.022, confirming continued short-term downward momentum. And the average true range is elevated at 0.0149, which confirms we are in a high volatility environment. Expect massive, unpredictable swings in either direction. But the momentum oscillator that deserves your closest attention right now is the Relative Strength Index. The RSI has dropped all the way down to 34.20. We are approaching, dangerously close to, the traditional oversold threshold of 30. History has shown over and over again that when a stock with meaningful fundamental value and a 15% short float reaches oversold RSI territory, the snapback can be violent and swift. And if you spend any time in the retail trading forums right now, you can feel the exhaustion. Investors on platforms like Moomoo are expressing deep frustration with the complexity and pain of these dilutive deal structures. People who bought on the revenue growth thesis are watching their positions bleed, and the sentiment is fractured right down the middle. On one side, you have complete capitulation, people walking away. On the other side, you have a faction of deeply convicted bulls who are anchored to the long-term catalysts, the 443% growth, the healthcare platform, the GPU network, the 800 million in signed contracts. Two camps sitting on completely opposite sides of the same trade, each with a legitimate data-driven case. That kind of division in retail sentiment, combined with extreme institutional short pressure, is historically one of the most volatile cocktails you can find in a small-cap stock. And volatility, when you trade it correctly, is opportunity. So let's bring everything together and give you the exact actionable trade setup for the week of June 8th through the 12th. Based on the technical exhaustion signals, the approaching oversold RSI threshold, and the extreme short interest creating mechanical squeeze potential, we are looking at a contrarian long setup. The optimal entry zone is between 41 cents and 42 cents. This zone aligns precisely with the June 5th intraday low of 41 cents. Classic support level 1 at 40.9 cents, and the Fibonacci support level at 41.2 cents. It represents a zone of pure technical exhaustion, a place where sellers have historically run out of gas. That is your entry window. But capital protection is non-negotiable. Your strict stop-loss zone is at 39.5 cents. If the stock breaks convincingly below 39.7 cents support, the reversal thesis is completely invalidated. And if that level breaks, the next meaningful support is the 52-week low of 25 cents, which is a long, painful way down. Do not let a trade thesis become an emotional attachment. If it breaks, you cut it immediately, no hesitation. On the upside, your first take-profit target is between 46 cents and 47 cents. That zone aligns with the 50-day moving average and recent consolidation highs, a natural resistance area where you want to be taking partial profits and protecting gains. But if the short squeeze scenario actually triggers, if positive news on the Helmex definitive agreement hits the wire and the borrow fee spikes above 15%, then your second take-profit target is between 51 cents and 54 cents, driven entirely by forced short covering as bears scramble to buy back shares and fill the gap toward the 200-day moving average. That is a potential 30% move from the entry zone. High risk, but mechanically supported by the data. And the three catalysts you must have pinned to your monitor every single day this week. First, confirmation that the $25 million non-refundable payment was processed cleanly without breaking operational cash flow. Second, any announcement that the Helmex term sheet has progressed into a definitive, binding agreement, because if it fails, you are looking at an immediate $25 million permanent loss event hitting the stock. Third, watch that short borrow fee rate. If it spikes above 15%, that is your mathematical signal that a squeeze is actively building and the bears are starting to panic. Before we wrap up, I need to be very clear with you about something important. Everything discussed in this video is strictly for educational and informational purposes only. Nothing in this breakdown constitutes financial advice, investment advice, or a recommendation to buy or sell any security. Trading stocks, especially high volatility, speculative small-cap stocks like Datavault AI, involves substantial risk of loss and is not suitable for every investor. Always do your own due diligence. Consult a licensed financial advisor before making any investment decisions. Past performance and technical patterns are never a guarantee of future results. Protect your capital above everything else. All right, Smart Stock SAM community, here is where we land. Datavault AI is one of the most fascinating and treacherous setups in the market right now. 443% revenue growth colliding head-on with dilutive financing risks, a $25 million non-refundable fee gamble, insider selling across the board, and nearly 70% of the shorting happening in the dark. But underneath all of that chaos sits a coiled spring, an oversold RSI, a 15% short float, and borrow fees approaching 13%. The spring will release. The only question is which direction it uncoils first. Here is your question for the comments, and I genuinely want to hear your thinking on this one. Would you trust a management team that is actively selling their own shares while simultaneously paying a non-refundable $25 million to close a $2 billion deal? Drop your answer below. Let's have a real conversation. If this breakdown gave you clarity on a stock you were confused about, smash that like button. It genuinely helps more investors find this content and make better decisions. And if you are not subscribed yet, hit subscribe and ring the notification bell so you never miss a breakdown like this one. If this video added real value to your trading, consider showing your support by sending a super thanks right here on YouTube. Every bit of support helps us keep producing deep research content like this for free. And finally, if you are serious about leveling up your investing and trading, our exclusive Smart Stock SAM membership community is now live. Inside, you get early access to trade setups, priority replies to your queries, and a community of serious traders who are all working from the same data-driven playbook. The link is in the description. Come join us. Until next time, trade smart, protect your capital, and always let the data drive your decisions. I will see you in the next breakdown.